Oh boy, this is going to be so much fun. Dear students, we are ready to start our journey, about 4 or 5 weeks or so, on stocks. Exciting stocks, sexy stocks, dangerous, risky stocks. Yeah. Folks, stocks are where the action is, especially if you are a long-term investor. But, as we'll see, there are landmines waiting for us in our journey, so we have to learn how to deal with them. Avoid some you can't avoid. But it turns out that if you're a prudent long-term investor and you don't panic, those landmines turn into golden opportunities. But I'm getting a little ahead of ourselves, aren't we? We're getting a little ahead of ourselves. Let's get started from the beginning with Chapter 5, and quite a bit of it actually is lecture notes, our introduction to stocks and the stock market. We start with a quote from a humorist who was very popular in his heyday in the early part of the 20th century, the first part of the 20th century, Will Rogers. Don't gamble, take all your savings and buy some good stock and hold it till it goes up. And if it don't go up, don't buy it. Well, yeah, well, his generation, they learned the hard way, right, in the roaring 20s, when the business of America was business, Calvin Coolidge said. Yeah, it all came crashing down around them on the Great Depression. The last 20-some-odd years had been extremely prosperous. After the World War I debacle, they saw the modern world, and they thought the future is bright, blue skies, productivity gains. When was that? That happened again before in the 1960s and then again in the late 1990s. It's a cycle, folks. It's a cycle. So let's learn how to identify, ride it, and then deal with it. Slide number 2. What are stocks? Well, as we said in our first chapter when we took a look at the investment universe, stocks represent ownership in a corporation, in a publicly traded entity called a corporation. And when you take Business 120, if you take Business 120, Introduction to Business, you will learn about the various types of businesses, and corporations just being one of them. Where did the term common stocks come from? Well, most people don't use that term, but that's what, when we say stocks, we're normally talking about common stocks. Well, it goes back to the original folks who started these things back in the 1600s in the Netherlands and the United Kingdom. The shareholders were shareholders in common, meaning every person who owned one share had one vote. And obviously, if you had more than one share, you had more than one vote. And if you had 50% plus one, well, then you basically ran the corporation because you could always vote your way and nobody else could stop you. We also use the term, or hear the term, equity financing. Right, stocks are equity financing as opposed to bonds, which are debt financing. Stocks enable investors to participate in the profits and growth generated by the business enterprise. But stockholders are limited liability owners. We can only lose our investment. Unlike a sole proprietor, which that person, the business and that person are one and the same. So if the business incurs debts over and beyond the assets that are available to pay those debts, that person is on the hook for those debts. That's not true with a corporation. Now, there are situations where the courts have been able to pierce the corporate veil, but they are not in any stock that we're going to look at. That's not that. The companies that we're going to look at are bona fide, which is a fancy word for real. You know, they're serious corporations, companies, and they're not attempts by people to hide assets. That's the situations where the corporate veil is pierced. In our situation, no, we'll never have that problem. So if you lose $100 in the stock market, they're not going to come after you for more money. What are the two things that stockholders receive? Optionally, right? Dividends, which are optional payments of earnings. The board of directors does not have to pay dividends, although some companies have been paying dividends for over 100 years. And capital gains, also called capital appreciation. The value of the corporation rises as the business grows, although, again, that's not guaranteed either. That is optional, and of course, we could lose money. Contrary to what many believe and how many people behave, stocks are not simply millions upon millions of worthless pieces of paper, now electronic bits, that people trade each day for no apparent reason. No, they represent ownership in real businesses. And we're going to take a look at some of the real businesses, and we'll take a look at some of the imaginary sham businesses also, which you're going to stay away from, right, dear students? Nod your head. Thank you very much. Thank you for nodding your head. Slide number 3. Let's take a look at the historical performance. The stock market has returned over the long term of modern finance around 10, 11%. Again, I tell people 8, 9, 10%, even though it's done better than that, for the last 80 some odd years, 90 years. Now, why do we say 80, 90, 100 years modern finance? Well, there are historical reasons that we really don't want to get into now. But let's say that the modern world started as the 20th century began, 19th century ended. You know, there's no clear-cut demarcation. But certainly we saw the seeds of the modern world in the Industrial Revolution. And it was the railroad, dear students, more than anything else, that changed the modern world for good, because no longer did you have to buy your goods and services close to you. I mean, there was global trade, to be sure, but it was very, very limited because it was limited by the oceans, right, by ships. But now with railroads, indeed. There are other things, folks, to be sure. There are other things, but that was the biggie. So we'll leave that for you history buffs. But in any given year, it is unlikely that you're going to get 10 or 11%. And the return, as we saw back in Chapter 1, has varied from a high of 53% to a low of minus 43.5%. And 2008 was almost minus 40%, one of the worst. Yes, in any given year, there is about a 1 in 3, 1 in 4 chance of a down market. So you can't tell what's going to be next. You can't say 1, 2, 3 up and then 1 down. 1, 2, 3, 4 up, down. It doesn't work that way. You know, it might be 3 or 4, 5, 6 years in a row and then 2 down years. The great exception was the run up from 1982 to 2000, where the market went in 2 directions, up and way up. And then had 3 years in a row down. Exactly. You don't know. As we saw in Chapter 1, it's all statistics. But we know it's going to happen. We know there are going to be down years. It's just part of the game. Look at the graph that we took a look at. Let's review this graph that we took a look at in Chapter 1. And again, I want you to ignore small company stocks because that is not good. That is not good. But for large company stocks, yes, they have trounced treasury bills. They have trounced government bonds and inflation. And it only makes sense. As the economy continues to grow, the companies that produce the goods and services will grow, and we should prosper if we invest in the stock market. But the problem is that those little bumps that you see here, those are not little bumps, dear students. This is a logarithmic scale, which means every time you go from 1 unit, it doesn't go up by 1, it goes up by 10, and then 10 to the second, and 10 to the third, and 10 to the fourth. So these little bumps here are actually seismic proportions. Those are seismic tectonic shifts. They're earthquakes, and that's why we use a logarithmic scale for earthquakes too, right? So we have to be prepared for that. And now let's take a different view that allows us to look at rolling 10-year periods. Now, this is a really good graph, folks. I want you to take a little bit of time. I know some of you don't like graphs. I don't blame you. I remember I told you I was a math major, so I understand them, but I understand, and I've helped people. I used to tutor math. I used to teach business math, so I know that some people hate math. But I want you to take a good look at this graph, because these are rolling 10-year periods. What does that mean? We started in 1928 and we went 10 years forward. If we put whatever amount of money, $100, $10,000, whatever, what happened to that? What was our annual return over those 10 years? This is the Dow Jones Industrial Average. And it turns out, by going back to the Great Depression, we lost money in 10 years. We put in $10,000. 10 years later, it was down. 1929, 1930. But then, coming out of the Great Depression, we see that the average annual return starts to do better. Yes, it does. And then, bingo, World War II happens. And then, coming out of World War II, we had the go-go years, 1950s, 1960s. And the economy zoomed ahead, and every man a king, a chicken in every pot. Everybody's going to have a car. We got to get people to spend, and throw away cars in 2 or 3 years. And the stock market exploded. And we see in the 1950s, indeed, average annual returns of almost 20% a year for 10 years. Zoom! Rich, hurry up! They're giving away money, folks. Just run down. And then, of course, the 1960s happened. And we had the little tremors. But still, everything is still cool. Everything? No, it's not. 1970s. What happened? Well, a few things. You students of history, and some of you lived through it. But we had some very big shocks. The Vietnam, Watergate, the first oil shock, and then the second oil shock. Stocks were overpriced by all reasonable measures. We had the Nifty 50, which meant that these were companies that you didn't even have to worry about buying. No matter what, they were always going to go up. That's what happened in the 1920s. Disco, yeah, that was rough too. No, it wasn't disco. No, but the biggest problem was the baby boom generation. You had this huge bulge in the population, all coming of age, all having to go out and get jobs and buy cars and houses and shoes and refrigerators, and it was a very difficult time for the markets, folks. And we see a 10-year period where you didn't lose money, but you didn't really gain very much. You had an average annual return of 0.01% or whatever it was. But then here we come out of the 70s, and we have globalization and computer technology and internet and blue skies, and all the other countries and the communist countries say, you know what, this stuff is for the birds. We want capitalism too. And sure enough, blue skies and productivity gains. Who needs a typewriter anymore? Everybody's going to have not even a secretary. You're your own. Everything is fabulous. And sure enough, the stock market responded, and you had, again, average annual returns of close to 20% for 10 years. And then the wheels decided to fall off because stocks were way out of balance, folks. Some were just insanely expensive, as we'll see later on. Not all. In fact, in the late 90s, some stocks, the old economy stocks, if you're old enough to remember that term, versus the new economy stocks, the old economy stocks were actually going down in the late 90s. Who wants to own food companies or real estate investment trusts? I mean, they own shopping malls. There's no going to be any shopping centers anymore. Everybody's going to get everything off the internet. And sure enough, we saw 10-year periods, the Great Recession, first the internet bubble bursting, and we had the recession of 2001. But, we kind of came out of that. But the NASDAQ, the technology stocks were hammered, so many of them just disappeared. And then we had the Great Recession. The internet bubbles morphed into the real estate bubble. And, yeah, people lost their homes, millions of people, foreclosure. And you have to go back to the Great Depression to see annual average returns that are negative for 10-year periods. But hey, Look at what's going on. We're back up. We're back up now. What's going to happen in the future? I don't know. Are we going to have this same kind of cycle? Personally, I don't think so. It doesn't mean I'm right. Because you look at the growth rate in the developed world, and it's pretty anemic. Why? Because of, again, demographics, because of people. Our populations are aging. We would always invigorate our economy by immigration, and what kind of a hot button that's become. So it's very unlikely that we're going to see that kind of return in the developed world. But yes, dear students, the developing world is coming on strong. And people don't want to hear this, especially Trump supporters. Especially individuals who believe that the United States is the most important country in the world and there's nobody better. And so, folks, we're 4% of the world's population. On my home website is a little presentation that I show the face-to-face classes. And it asks people to just take a few guesses about the world's population. Where are they? Who are they? And invariably, when you show them the answer, first I ask them to guess, and then I show them the answer. They gasp. You get a lot of gasps. So if the developing world comes through the way many of us, myself included, believe they will, there's no guarantee. There are no guarantees. We might just see this same kind of skyrocketing of the stock markets around the world, because that's where the growth is. There are still hundreds of millions of people around the world, billions, not a couple billion, who are living in poverty. Over 1 billion people still live on $1 a day, dear students. And, we've got a long way to go until we have them with adequate food, adequate clothing, and shelter, and vaccinations, and they want cell phones, and they want internet access, and tremendous opportunities, as long as we don't blow ourselves up and learn how to live and we learn how to live with one another, which is a big if. We'll see. Stay tuned for continuing developments. But I'm very optimistic that over the next 15, 10, 20 years, I've told you this before, I believe we're going to see unprecedented prosperity. The biotechnology world is going to cure things that we never believed we could cure, like cancer and other intractable, that's a fancy word for serious problems, intractable problems, health problems, food. Yeah, I'm excited. I'm optimistic. But then again, the pessimists always say I'm not feeling realistic. I am being cautiously optimistic. Because, we humans have a tendency to screw things up. As much as we do good things, we also have a tendency to shoot ourselves in the foot at times. So let's see. Slide number 6. Continuing historical performance. Traditionally, close to half of the return from stocks was from reinvested dividends. You see, stockholders used to expect 4 to 6% in dividends each year. That was as much or more than bonds returned in interest, since stocks were considered much riskier than bonds. And if you look at the Standard & Poor's 500, which we'll take a look at in more detail in subsequent sessions, the 500 largest companies based in the United States, traditionally, now some of them are based outside the United States, the dividend rate from 1936 to 2008 was 3.8%. And remember, a lot of companies never paid dividends, but a lot of them have paid dividends for decades. But dividends fell to less than 2% and even 0% for many. And if you go from 1997 to 2007, the average was 1.5%. So people are not as enamored with dividends these days. And why is that? Well, there's various reasons. Dividends were taxed at a higher rate than capital gains, but that's not true anymore. People wanted the business to reinvest the earnings for growth, instead of distributing it to the investors. A lot of that was true. People said, don't give me dividends. I want you to grow that company. I'm interested in capital gains. Stocks were no longer considered riskier than bonds. Well, I don't know who believes that, but there are some folks who've come out with treatises and books and novels and papers that show stocks really are not riskier than bonds. Yes, if you have a long-term perspective, they're right. If you have a long-term perspective and you're not a human, if you're a computer that has no emotions, you can say, "Oh, I'm not worried about a 40% decline." But you know what? We're not computers. We're not machines. We are emotional creatures. We're not rational. Savings accounts are also paying less than 2%. Well, that's true. Since the Great Recession, savings accounts have been paying almost nothing. And people have lost track of their senses and bid up their prices. And that's something to be said for that, too. So, let's take a look at this graph. Because this is another graph. I apologize to the math phobics out there. This is showing us the yield on bonds versus the yield on stocks. And if we go back to the 1960s, as we said, they were fairly close to one another. If you go back even further, they were really close to one another. And what do we see? As inflation started to take hold in the 1970s, as the baby boom generation came of age and all started bidding up the prices of housing, cars, and shoes, and the like, we see that the yield on bonds going up. And inflation is a bondholder's worst nightmare. At the end of the 1970s, the Federal Reserve Bank ratcheted short-term rates up to 22%. Yeah, and the bonds followed suit to break the back of inflation, and it worked. It worked. The gentleman his name was Paul Volcker. He's still around. He worked, believe it or not, he's a Republican, but he worked for the Obama administration after the Great Recession. Stayed in the background. It's the kind of guy he is, but he's very, very sharp guy. And notice that the yield on stocks also went up. And why is that? Because of the price of bonds going down. And then we see the the former Federal Reserve Bank chairman after Paul Volcker, Alan Greenspan, called it the Great Moderation. We see bond yields coming down, stock yields coming down until 2000, when stock yields hit their lowest point. The Standard & Poor's 500, 1%. Right at the time, right, the stock bubble, the NASDAQ bubble, and the stock bubble as a whole, the S&P 500 losing 50% over the next 2.5 years, the NASDAQ, the tech-heavy part of the stock market, losing 80%. And then we see the stock market coming back. Well, yeah, the stock market came back and so did the dividends, coming back up. And then we see the bonds coming down until 2008, when there's a disconnect. What happened? Interest rates plummeted in the Great Recession, and so did stock prices. And since the stock price rose, the dividend, many companies reduced their dividends substantially. So some cut their dividends, but a lot of them didn't. And so we see the price going down, so the yield going up, because the yield is calculated by taking the dividends divided by the price. And we'll see that in a later presentation. And dear students, whenever you see this, whenever you see bond yields below stock prices, it's not a guarantee, but always the stock market has responded. Always the stock market has done better over the next 1, 2, 3, 4 years or so. And so that's exactly what happened in 2009, 10, 11. And then again, it happened in 12. The bond yields fell below the stock yields. And 2013 was a banner year for the stock market, about 30% or so. It was an awesome year. And now we see it again. We see bond yields again flirting, but that's not true. The last couple of months, the bond yields have come back up. So I don't know if I'm going to do this. I somehow have to get this to show the bond yield snaking back up. But that was after, because this is doing it every 6 months. I have to I don't know how I'm going to do that. But in the fall, you'll see the bond yield jumping back up above 2%. But right here, you see it below 2%. So let me see if I can somehow finagle that and change that. I have to change the dates. I have to change the dates that they're checked. They're like every 6 months on the 6-month period. I have to play with it. But yes, we see the bond yields have jumped back up after the election. That's what happened. So is that good news? We'll see. We'll see, dear students. We'll see what happens over the next few years. We'll take a look at measurements and evaluations over the next few weeks. But I'm optimistic about the next 5-10 years. For the next couple of years or so, I don't know. Anyway, we could 10% jump, 10% down. That's par for the course. But over the next 5 to 10 years, 15, 20 years, I'm very optimistic. Very, very optimistic. Slide number 8. The pendulum swings. The bear markets of 2000 to 2002 and 2008 have changed investors' perception about dividends. We now see investors in companies focusing more and more attention on dividends. Many companies that never paid dividends in the past are doing so now. Yeah, why? Because many tech companies are no longer growth stocks. They don't need the earnings. How many times can Microsoft rewrite Word? Every time they do, it gets worse. Every time they rewrite Windows, it gets worse, right? So what are they doing? They're paying out those earnings in the form of dividends because they are now mature industries. Also, the tax law has changed dividends, so they're taxed roughly the same as capital gains. So you can't use that excuse anymore. Now, there's a book by a woman named Geraldine Weiss. I'm not sure if she's still around. She might be retired. She was based in La Jolla. And I never read the book. I skimmed through it. It's not a very good book. But Dividends Don't Lie is a phenomenal name, right, for the book. That's what she called it. And I love that name. Dividends Don't Lie. Yes, dividends, that is money in your pocket, cash in your pocket. Well, they don't send you a check anymore. It's all electronically deposited into your account. But still, that's the one number you know is not a lie. You could look at their balance sheet, their income statement, their statement of cash flows, and we will later on. And they all could be made up. Enron, WorldCom, Global Crossing. Yeah, hanky-panky accounting gimmicks and tricks. But you know the dividends are real because they sent you a check. Well, they don't send you a check anymore. And this quote is attributed to John D. Rockefeller, he of the Standard Oil fame. We don't know if it's actually true because somebody else said that he said it. Do you know the only thing that gives me pleasure? It's to see my dividends coming in. He probably didn't say it, but it's a great quote. So dividends don't lie, students. Will spend quite a bit of time on dividends. Yours truly is a big fan of dividends. Slide number 9. The pros and cons of stock ownership. The advantages and the disadvantages. And you need to know these, folks, because if somebody asks you a question about stocks and your brother-in-law, Mr. Know-It-All, starts going off and saying things that people just don't understand, so they're sorry they asked him, you come in there and you say, well, you know, there are advantages and there are disadvantages, like as any investment. You know, investment's perfect. And the advantages are that they allow us, the general public, to share in the rewards of a business enterprise without having to start a company, and get all the capital, which is a fancy word for money, resources, to get the business running. Plus, most of us just don't have the wherewithal or the knowledge or the drive or the motivation or the skill to run a business. They have, I keep telling myself to change this to best financial investment returns over time because the real estate people get really angry at me. I'm going to write that down. Write that down right now so I do this. Best financial, slide number 11. The best financial investment returns over time be from dividends and capital gains. They're easy to buy and sell. Stocks are very liquid, assuming, again, you go with a bona fide, which is a fancy word for a serious company. Very liquid. And we talked about the limited liability, again, if it's a real company, a bona fide corporation. And the one thing that we don't discuss, although I like to throw it into the conversation, is that capitalism has increased the standard of living for as many people as possible. You know, there are serious problems with capitalism, folks. One might say it is the absolute worst economic system out there for delivering goods and service to a population, to an economy, to a country, except for all the others. Right? You know, if something better comes along, fly up the flagpole, see if anybody salutes. But until then, you know, this is what we're living with. We have to do something to increase the equity. You know, right now there's too much inequity that's in the system, And this is a problem. It's a problem. You don't want to destroy the motivation. You want certain people to become wealthy because of their fruits of their labors. But at the same time, we've got to share that wealth with everybody. Eventually, if we all want to live. I keep thinking, I know I've told you this already, but I think of Star Trek. I'm a big fan of Star Trek. And it's about 200 years in the future. And everybody has everything they need. Everybody has food, clothing, shelter, and internet access. And so we have to work on that. We do have to work on that without destroying the system that has made it all possible, without destroying the motivation, the drive for people to become very, very wealthy through starting a business. What are the disadvantages? Well, folks, there are always disadvantages no matter what investment you invest in. And with stocks, the big deal is the volatility, the risk, the downturns, the market crashes, the bear markets, the corrections. Prices go down, and you're going to live through those. You're going to live through several if you're a long-term investor. And we need to learn how to deal with them, and we will. We'll see that if we have a long-term investment horizon, then this is actually a good thing. We touched on it back in chapter 14 when we put our $50, $100 a month into our mutual fund. And the same thing is true for stocks, although it's magnified because we don't have 200 stocks or 200 bonds. We only have one person. 20 is a plenty for one person. And then there is the corporate and financial industry, hanky-panky, trucos, travesuras. Yes, that's where the money is. So we have to be careful about that, especially if you don't believe, yours truly, and believe that you can actually make money in penny stocks. Then I wish you much success, but I don't know. Right. Enrons are the exception, folks. They don't come along too often, but they're out there, and we need to be careful. Slide number 10. Volatility. Again, remember what does volatility really mean? It's a euphemism for I lost a lot of money. When you ask everybody, how is that stock you bought? Oh, it's been volatile. That means he bought it for $12 and sold it for 30 cents. Or maybe he hasn't sold it yet. I asked you that, didn't I? Did I ask you if you know anybody who's bought a stock for actually it was $11.88 and then sold it for 30 cents? I know somebody who's done it. I've known him all my life. He's kind of a goofy guy, teaches finance and investments at South. It was a great stock, folks. It was going to make synthetic blood, and they had done it, and it wasn't their fault that they fell into the organic mess out back. It had to do with something completely out of their control. But hey, that's when you invest in companies like that don't have any earnings yet, that are totally speculative, that's the kind of result you can get. You invest in companies that do have earnings over the last 60 years, have paid dividends over the last 40 years, continue to pay so and pay those dividends, and look like their business is not going to evaporate, you should do pretty well. But let's take a look at what happened in the short term. Because here we are at the beginning of 2016. And we put $10,000 into the stock market as the S&P 500. Maybe you put an index fund, the S&P 500. And boy, I lost 10%. I lost $1,000 in a matter of weeks. And so you take the money out just in time for the market to rebound. And it looks like things are going to go well. So you put money back in, and then Brexit comes along. Brexit. Yeah, the British exit. And you take it out just in time for the market to recover, and then the election happens, and the world didn't end, and so the stock market responds. Actually, here's the election. Before the election, it started going up, and here's after the election. And actually, you did pretty well. If you didn't take it out, and then put it back in, and then take it out and put it back in. Are you getting it? Is it sinking in? I sure hope so. By the way, we will re-examine volatility in a subsequent presentation. So, dear students, are you excited? I hope so. Go back over, make sure you understand and internalize the items in the presentation. And in our next presentation, we will take a look at the stock markets, the places the locations, and now the cloud, the electronic place up in the sky where stocks are bought and sold. Welcome to Stocks. Study hard, bring honor and glory to Southwestern Community College. We are happy, proud that you're here, and we want you to be rich. Yes, we do. See ya.